There's a specific financial paradox that affects people in the middle of the income distribution more than anyone above or below them. And people with very little income know exactly how constrained they are. People with substantial wealth have crossed the threshold where the math takes care of itself. In the middle, earning enough to feel stable, not enough to have genuine stack, is the zone where the most sophisticated financial traps operate. And because they're designed for people who have just enough income to be sold things they can technically afford, but genuinely can't afford to keep buying, these traps don't look like traps. They look like the normal, responsible, appropriate choices for someone at your income level. And that's what makes them so expensive. And here are the ones that quietly drain the middle class wealth for decades. Trap one: house poor. The most culturally normalized middle class trap is buying the maximum house the bank will approve and not a house that fits the budget. The maximum house the mortgage calculator will permit at interest rates, and the financial institution's approval is based on what you can technically service in monthly payments, not on what leaves you with sufficient margins for retirement savings or emergency reserves or regular expenses and the life you want to live outside your mortgage payment. And the conventional guidance is to spend no more than 28% of your gross income on housing costs, mortgage, principal, interest, tax, and insurance combined. The mortgage industry regularly approved buyers at 36 to 43%, and the difference between 28% and 40% of gross income on housing is not a modest lifestyle difference. It is the difference between a financial life where other goals are achievable and one where the house payment has consumed the margin that everything else depends on. The house poor is the condition of owning a home that absorbs so much of your income that the equity building of home ownership is offset by the absence of investment in other asset classes and the reliance on debt for irregular expenses, the inability to save at meaningful rates, and the persistent financial anxiety of running thin margins on a high fixed cost. The house may appreciate. The financial opportunity cost of the years spent house poor often exceeds the appreciation. The specific number to know before buying what percentage of your take home pay, not gross, your take home, will the total housing cost represent? If the answer exceeds 30% of take home, the house is buying you a more expensive version of the same financial constraint you were trying to escape. Buy less house. The savings rate that becomes possible in the margin is worth more over time than the square footage. Trap number two: the subscription creep into lifestyle inflation. We talk about it all the time. The middle class income level is the precise target of the subscription economy, not the wealthy who buy things outright, not the cash constrained who can't afford the monthly fees. The middle people who can absorb a $15 monthly charge without immediate pain and who have been demonstrated by a decade of digital service growth to absorb dozens of them simultaneously without the aggregate of total registering as significant. And the average middle income household now carries $300 to $500 per month in subscriptions and recurring service costs. Streaming, software, fitness, food, services, news, storage, apps, and membership. And most of these were added individually at moments when the monthly costs seemed trivial. I mean, as small relative to the value offered. Collectively, they represent a $3,600 to $6,000 annual expense that grew incrementally without any single decision that felt like committing to that total. What makes this specifically a middle class trap rather than a universal one is the income ceiling that enables it. The subscription economy requires sufficient income to absorb the reoccurring charges without triggering the immediate pain response that would produce cancellations. And the middle earner is squarely in the target zone. Enough income to absorb each new addition, not enough income for the accumulation to be materialized. In the annual subscription audit, pulling every reoccurring charge from every payment method and evaluating one against its actual current value consistently produces $100 to $200 per month in savings for middle income households. And this is not a sacrifice. It's a reclamation of money that was leaving the account for services that were no longer delivering equivalent value. Trap number three: Car payments. As a permanent feature, the middle class financial life typically contains a car payment as a permanent budget line item, not a temporary. As a vehicle is required and paid off permanently, a rolling upgrade cycle where each vehicle is financed, paid down to positive equity, traded in as a down payment on the next finance vehicle, and the payment continues without interruption for decades. The average new car payment in the United States in 2025 was $736 per month. The average new car was 523 per month. A household with two car payments and committing $1,000 to $15 per month to vehicle financing or 12,000 to 18,000 per year in payments on assets that depreciate over 20 years. That monthly commitment invested instead would represent 500,000 to 750,000 at 7% average return. The alternative that most middle income earners have access to barely rarely choose: buy a reliable used vehicle with cash, maintain it well, and drive it for 8 to 12 years before replacing it. The vehicle quality required for reliable transportation over this timeline is 3 to 5 year old models with under 60,000 miles, purchased for 12,000 to 20,000, a one time purchase that eliminates the monthly payment entirely rather than rolling it forward indefinitely. And the psychological barrier to the paid off vehicle strategy is real and worth naming. A newer, nicer vehicle communicates success in a way that a modest older car doesn't. And that communication matters in environments where professional appearance and social comparisons drive the behavior. This is a genuine cost of the strategy, and it also a cost that many people pay for, an audience that notices far less than assumed. Trap number four: keeping up with comparable earners, the reference group problem, the tendency to calibrate spending against the visible consumption of people at similar income levels. Hits middle income earners particularly hard because the middle is large and enough that the most visible peers are always spending at the higher end of the range, creating a perpetual sense that the current spending level is normal or even modest. The colleague who takes international vacations twice a year, the neighbor who renovated their kitchen, the friend group whose restaurant choices have gradually migrated upwards. These are not representative of the actual spending of people at their income level. They are the visible surface of a distribution that includes significant debt, depleted savings, and financial stress hidden beneath consumption that performs financial comfort without reflecting financial health. And middle income earners who benchmark their spending against most visible peers in their income cohorts are consistently benchmarking against a curated presentation of financial life that overstates what those peers can actually afford. The financial models that look comfortable from the outside are frequently fragile from the inside. Spending too much to match the imports, fragility without the disclosure. Trap five: retirement savings as the things that happens after everything else. The structure of middle class financial life frequently treats retirement savings as the residual, the things that get funded with whatever remains after housing, transportation, food, lifestyle, and the various obligations have been satisfied in most middle income budgets. The residual is insufficient for meaningful retirement savings, which produces a retirement funding gap that compounds over time into an increasingly difficult problem. And the specific trap is the 401k contribution floor. And most middle income earners contribute enough to capture the employer match, at typically 3 to 6%, and treat that as the retirement savings decision resolved. Capturing that match is correct. Stopping at the match is a trap. The match plus the minimum contribution rarely produces retirement savings at the rate required to fund a meaningful retirement at a reasonable age. And the gap between what most people are saving and what the math requires is large enough to be genuinely alarming when it's calculated explicitly. The correct retirement savings rate for most middle income earners who started saving in their late 20s or early 30s is 15% of gross income, including employer contributions. Mostly are saving 6 to 8%. The gap compounded over 20 years is not a small difference in retirement. Comfort is the difference between financial independence at a reasonable age and working indefinitely because the math doesn't permit stopping. Automate the gap closing, increase the retirement contribution by 1% of salary every 6 months until the 15% target is reached. Each increase is small enough to absorb into the existing budget with the minimal distribution. And the accumulation of those small increase over 2 to 3 years close the gap that currently defines the most expansive long-term middle class trap of all. The pattern across all five. Every trap on this list is normalized. House poor is what responsible homeowners do. A subscription creep is how modern life is structured, and permanent car payments, how most people manage transportation. And spending like your peers is how social belongings function. Retirement savings as the residual is how most employers' benefit structures are designed. Normalized doesn't mean optimal. It means enough people are doing it that it stops generating friction from the people around you who are doing the same thing. The middle class traps are expensive precisely because they're invisible against the background of everyone else's identical behavior. See them as choices rather than defaults, and the ones that don't serve you become optional. And that's the whole work. Thanks for watching. If you found value in today's video, please subscribe. That way we can stay here on YouTube and continue making content. Check out this video to the right, and we will see you on the next one.